Hello, and welcome to Investuition, a community where you scale up your knowledge. One Up on Wall Street is a book written by Peter Lynch, one of the most successful investors in the history of Wall Street. The book offers a comprehensive guide to investing in the stock market and provides valuable insights into Lynch's investment philosophy and strategies. Lynch's approach to investing is based on his belief that anyone can become a successful investor by using their common sense, doing their research, and investing in companies that they understand. He emphasizes the importance of doing thorough research, looking for companies with strong fundamentals, and investing for the long term. Throughout the book, Lynch shares his experiences and offers practical advice for investors at all levels. He also provides valuable tips on how to identify undervalued stocks and how to manage a portfolio for maximum returns. Whether you are a seasoned investor or just starting out, One Up on Wall Street is a must-read for anyone looking to succeed in the stock market. It offers a wealth of knowledge and insights that can help you make informed investment decisions and achieve your financial goals. Let's understand the principles in detail and begin this video. Principle 1. Invest in what you know. Lynch's investment philosophy is based on the idea that investors should invest in what they know. He believes that investors can gain an edge by investing in companies that they are familiar with and that they understand. Lynch advises investors to look for companies in their daily lives, such as stores they shop at, products they use, or services they use. He suggests that investors should focus on companies that are easy to understand and that have a simple business model. Lynch argues that investors who invest in companies they don't understand are more likely to make mistakes and lose money. He suggests that investors should stay away from complex companies with unclear business models and instead focus on simple, easy to understand businesses. Principle 2. Do your own research. Lynch emphasizes the importance of doing your own research when it comes to investing. He believes that investors should take the time to understand the companies they are investing in, including their financials, management, and competitive position. Lynch advises investors to read annual reports, listen to conference calls, and keep up with industry news and trends. Lynch argues that investors who rely on tips from others or who follow the crowd are more likely to make mistakes and lose money. He suggests that investors should do their own analysis and come to their own conclusions about the companies they are investing in. Principle 3. Look for companies with a competitive advantage. Lynch suggests that investors should look for companies that have a competitive advantage. He argues that companies with a competitive advantage are more likely to succeed over the long term and generate higher returns for investors. Lynch suggests that investors should look for companies with strong brands, unique products or services, or a dominant market position. Lynch also advises investors to look for companies with a durable competitive advantage, meaning that the company's competitive position is likely to last for many years. He suggests that investors should look for companies with a moat, which is a barrier to entry that prevents competitors from entering the market and competing with the company. Principle 4. Buy undervalued companies. Lynch suggests that investors should look for undervalued companies, meaning that the company's stock price is lower than its intrinsic value. Lynch argues that undervalued companies have the potential to generate higher returns for investors as the stock price catches up with the company's true value. Lynch advises investors to look for companies with a low P/E ratio, which is a measure of the company's stock price relative to its earnings. He also suggests that investors should look for companies with a low P/B ratio, which is a measure of the company's stock price relative to its book value. Lynch cautions investors against buying overvalued companies, which he defines as companies with high P/A ratios or high P/B ratios. He suggests that overvalued companies are more likely to experience a decline in their stock price as investors come to realize that the company is not worth as much as they thought. Principle 5. Diversify your portfolio. Lynch advises investors to diversify their portfolio by investing in a variety of companies across different industries. He argues that diversification can help reduce the risk of investing and can help investors capture returns from different areas of the market. Lynch suggests that investors should aim to have a portfolio of 10 to 20 companies across different industries. He advises investors to avoid over-diversification, which can dilute returns and make it difficult to keep up with all of the companies in the portfolio. However, Lynch also warns against under-diversification, where investors have too much money invested in one or a few companies. This can lead to a higher risk of losing money if those companies perform poorly. Lynch suggests that investors should aim to have a balanced portfolio of companies that are in different industries and have different risk profiles. He also advises investors to monitor their portfolio regularly and make adjustments as necessary. Be patient and focus on the long term. Lynch emphasizes the importance of patience and a long-term focus when it comes to investing. He suggests that investors should not be swayed by short-term market fluctuations or try to time the market. He suggests that investors should be willing to hold on to their investments for several years or even decades, as long as the company's fundamentals remain strong. Lynch also advises investors to avoid the temptation to buy and sell stocks frequently. He suggests that this approach can lead to higher transaction costs and can also result in missed opportunities for long-term gains. Principle 6. Invest in companies with strong management teams. Lynch suggests that investors should pay attention to a company's management team when deciding whether to invest. He argues that companies with strong management teams are more likely to succeed over the long term and generate higher returns for investors. Lynch advises investors to look for management teams that have a track record of success, a clear vision for the company's future, and a commitment to creating value for shareholders. He also suggests that investors should be wary of companies with poor management, as they are more likely to make mistakes and underperform over time. Overall, Peter Lynch's investment philosophy is based on the idea that investors should invest in what they know, do their own research, look for companies with a competitive advantage, buy undervalued companies, diversify their portfolio, be patient and focus on the long term, and invest in companies with strong management teams. That's it for today's video. We see you soon with another interesting and knowledgeable video like this.